Okay, so this is Tax Savings with Real Estate Ownership Explained, and I'm Jessica Chisholm. I'm a CPA at Huddleston Tax CPAs, and we're located just outside of Seattle, Washington. Before we get started with the presentation, I just want to show you a couple websites. First is smallbusinesswebcast.com. You guys may have all come to us today from smallbusinesswebcast.com, but if you came to us from another website, I want to make sure that you go ahead and make sure you're registered at smallbusinesswebcast.com. We made aware of future webs. I just want to let you know what some of those webcasts are. On July 27th, Lance Holbert will be doing tax update. He'll be explaining the new tax legislation. On August 3rd, John Huddleston will be doing LLCs and S-Corps Explained, using them to reduce taxes. That's about how to select the appropriate entity for your business. On August 11th, I do a QuickBooks overview, essentials every user should know. On August 23rd, I also do tax savings for construction, architecture, and engineering firms. And I also do a tax savings for medical professionals. Jennifer Zhao in our office also does tax savings for small businesses, just a general overview for all small businesses. But she won't be doing that again until sometime in September. I also want to show you our website, Huddleston Tax CPAs. We're available to help any of your accounting needs should you be looking for a new CPA. We do tax prep We do tax prep and planning, coaching for small businesses, QuickBooks training, bookkeeping, payroll, pretty much any help your small business might need. Okay, so let's go ahead and get started with the presentation here. Again, if you have questions as we go along, feel free to type them in the chat. So the things I'm going to go over today are tax savings with personal residence, with owning your personal residence, tax savings with owning rental properties, what it means to be a real estate professional, and then I'll touch a little bit on house flipping and the tax impact of that. So when you own your own home, there are tax benefits if you have that. And some of the deductible items for owning your personal residence are deductible in the Schedule A of your personal Form 1040. And the things that are deductible are the mortgage interest that you pay on your home loan, points that you pay when you purchase or when you refinance, qualified mortgage insurance, and real estate taxes. So for the mortgage interest that you pay on the loan on your home, the interest is deductible on the first $1 million of home acquisition debt and the first $100,000 of home improvement debt. So if you take out a loan when you purchase your house for less than $1 million, then all of the mortgage interest you pay for the year is deductible on that loan. If you have a mortgage that you take out for greater than $1 million, then only you would take, say maybe you take out a loan for $1.5 million. So $1 million of that's 2/3 of your loan. 2/3 of your loan would be deductible. The interest would be deductible for the year. So it phases out after the $1 million. But you also can take out home improvement debt, maybe a second mortgage or line of credit, improve your home, and the interest is deductible in the first $100,000 of that. For the points, if you purchase your home, if you pay points when you purchase your home, then those points are deductible all in the year of the purchase of the home. If you pay points when you refinance your home, then those points would be amortized and deductible over the life of the loan. So if you refinance into a new 30-year loan and you pay points on that loan, then you would divide the points by the 30 years, and it would be deductible. A certain percentage would be deductible each year for the 30 years of the life of the loan. If you refinance or sell that house before you write off all those points, then the remaining points are completely written off in the year of the refinance or the sale of the house. For qualified mortgage insurance, if you pay qualified mortgage insurance on your loan, then it is deductible on Schedule A. If you started paying that mortgage insurance after, I believe, January 1st of 2007. Also, the real estate taxes that you pay on your home are deductible on the Schedule A as well. So those are all things that are a benefit for owning your own home. It allows you to itemize your deductions. Other things that are deductible on Schedule A that you wouldn't probably be able to deduct otherwise if you didn't own your home, because most people that don't own their home are not able to itemize their deductions, but rather take the standard deduction. So other things you can add to your to these deductions on Schedule A would be things like charitable contributions, medical expenses, personal property tax, and then miscellaneous itemized deductions like unreimbursed employee business expenses and tax prep fees. So another thing to know about when you own your own home is the principal residence exclusion when you go to sell your home. So when you're selling your main home, you may be able to exclude up to $250,000 or $500,000 if you're married filing jointly of the sale of your home if you meet the ownership test and you meet the use test. So the ownership test, you must have owned the home for at least 2 years in the 5-year period ending on the date of the sale. And then for the use test, you must have lived in your house as your main home for at least 2 years during the 5-year period ending on the date of the sale. So basically what it means is you can buy a home, live in it for a year, move out, rent it for 3 years, move back in for 1 more year, and you'll have met the ownership test and use test of 2 of the previous 5 years. So even though you rented it out for 3 years in between, you did own it and live in it for the first year and the 5th year. So you're still able to take this deduction or this exclusion. Also, during the 2-year period ending on the date of sale, you cannot have excluded gain from the sale of another home. So basically, you can only do it once every 2 years. So it's a nice benefit if you're selling your home for a large gain. You won't have to pay capital gains if on the first $250,000 if you're single, or $500,000 if you're married filing jointly. So that was all I wanted to talk about with the home ownership. The next stuff I want to talk about is when you own a rental home. So when you own a rental home, first I want to talk about the rental income. So you report income when it's received. So basically, maybe someone prepays their rent. Maybe they pay their January rent on December 25th. You would report that income in the year that you received it. So maybe they paid it December 25th of 2010, but it was for January 2011 rent. You still would report it on your 2010 taxes since you report when you received, because you're a cash basis taxpayer. Also, security deposits are not included in income. So maybe when you have a new tenant move in, you have a $500 security deposit that you charge. That is not included in your income until it becomes non-refundable. So you just hold on to that $500, and then when the tenant moves out, maybe $300 of that becomes refundable, and $200 of it you keep. That is when you would record that $200 as income. So you report it when it becomes non-refundable. So actually for that security deposit, if part of that initially, if you take $500 and say $100 of it is going to be kept no matter what, then that $100 would be reported as income when you take that security deposit. But if none of it is marked as non-refundable, wait until it becomes non-refundable. Also, if you rent out your home for less than 15 days, you do not need to report that income. As far as rental expenses go, again, they're deductible in the year paid. So again, just cash basis. So maybe you pay insurance expense for 6 months in December, but it's for the first 6 months of 2011. It's still going to be deductible in 2010 because that's when you paid it. Also, you're able to start deducting rental expenses whether or not there is a tenant in the home. So maybe you advertise the home as available for rent in January. It doesn't actually rent out until the beginning of May, and you have expenses for January, February, March, and April, like mortgage interest, property taxes, advertising for a new tenant, etc. Those would all be deductible even though there's no tenant, since the house is available for rent and you are actively trying to rent it out. Also, you cannot take a deduction for uncollected rent. So if you have a tenant in your house and they don't pay rent for 2 months, you're just out that money. You don't get to take a deduction on that on your for that on your tax return because you never received any income to take a deduction against. So a lot of people say, well, you know, they were living in my house for free. They didn't pay me. Why don't I get a deduction for this? It's because you never collected rent, so you can't take a deduction against it. It's just an unfortunate part of owning a rental property. Okay, so I want to talk about repairs versus improvements. So when you have a repair on a rental property, it is deductible when it's incurred, when the expense is incurred. When you have an improvement on a property, you need to capitalize that improvement and depreciate it over its useful life. So some examples of repairs are painting, if you paint the walls, paint the outside, fixing floors, maybe there's a couple bad boards in the hardwood and you need to replace them. That would be deductible as a repair. Fixing leaks, if you have a burst pipe or a broken sink, that would be a repair. Replacing broken windows, so maybe you have 1 or 2 broken windows and you replace only those windows. Those would be repairs and they would all be deductible when they were incurred. For improvements, some examples of improvements would be a room addition. So maybe you add on a sunroom to the back of the house or put in a new bathroom. That would be an improvement and it would be capitalized. A brand new roof would be capitalized. New plumbing, so maybe you have to replace the pipes in the whole house or in a whole room. And also new carpeting or flooring would be an improvement. So the improvements would not be expensed in the year that they were incurred, but rather capitalized and depreciated over their useful life. And I'll talk about depreciation a little more in a little bit. Some examples of rental expenses would be advertising. If you need to find a new tenant, whatever it costs you in advertising to find a new tenant. Cleaning, so maybe a tenant moves out, before a new one moves in, you have the place professionally cleaned. That would be deductible. Utilities, so if the rental is sitting empty and you're waiting for a new tenant and you're paying utilities on it, that would be deductible. Or if you include utilities in the rental price, so maybe you say that water, sewer, and garbage is included in the rental price and you're paying that out of your pocket, that would be deductible. Homeowner's insurance is deductible. Property taxes, interest on the mortgage. Some people like to list the entire mortgage payment. However, the principal portion and the escrow portion of your payment are not deductible. Only the interest portion is deductible. And also travel. So if you take trips to make repairs or to check on your rental, those are deductible as well. So depreciation. So examples of depreciable rental property are the building itself, however, not the land. Land is not depreciable, just the building. Appliances that you put in, new carpets. If you rent the place furnished, then the furniture would be depreciable. If you add a fence while you're renting it, that would be depreciable. Also, any additions and improvements that you do. So, let me see. So, for the depreciation, it's just like the improvements. You would capitalize them and depreciate them over their useful life. So some examples of what the useful life are would be for the building. The useful life of a rental property is 27.5 years. So you would take to figure out how to depreciate the building, you would take the purchase price of the building. You would then look at the property tax records to break out land portion of business and building portion. You would take the building portion of that purchase price, and then you would depreciate it over 27.5 years. For appliances, you would depreciate them over 5 years. Carpets, 7 years. Furniture, 7 years. Fence, the fence would be like an improvement to the building, so that would be likely 27.5 years, as well as any additions and improvements to the building would be 27.5 years. So depreciation can start to get tricky, knowing what the correct useful life is for something or whether or not it needs to be capitalized and depreciated or can just be written off. So that's it's nice to consult your tax professional when you own a rental property. They can usually give you some good insight and make sure you're not taking deductions incorrectly. So for rentals, there are limitations on rental losses. If you actively participate in your rental, then the rental loss is less than $25,000, then there's no loss limit. You can take the entire loss on your taxes. If you actively participate and your rental loss is more than $25,000, then you are limited to the $25,000 loss. The excess over the $25,000 does carry over from year to year. So if you have a year where your loss is less than $25,000, then you're able to take prior year's loss to make up to that $25,000 limit. Also, if you have loss carryover left when you sell the house, you're able to take the loss in that year. If you do not actively participate in the rental, then the loss is only deductible to the extent of other passive income. So active participation is when you own at least 10% of the property and you made management decisions in a significant sense. So if you're the only owner of the property, then chances are you actively participate in it. You're making decisions on how much to rent it out for, what repairs to make, who to use, things like that. Then you'd be actively participating in the rental. So one example for the rental loss, if you have a rental property that you actively participate in and it lost $30,000 for the year. If all you had was that one rental for passive income or loss, then you would be limited to $25,000 and $5,000 of that loss would carry over. However, in this case, you also have passive LLC income of $15,000. So the passive income offsets the passive loss, and you have a net passive loss of $15,000 to report on your tax return. So also in this example, if this first line, if it was non-active participation, and you had a rental loss of $30,000, and then you had passive LLC income of $15,000, then your net passive loss would be 0 for the year, because you would be limited to a loss for your loss on the rental if you're not actively participating to the extent of other passive income. So now there is a income phase out for the losses. So if your adjusted gross income is less than $100,000, then you can take the full loss up to the $25,000 that we were talking about. However, once your adjusted gross income goes over $100,000, it starts to phase out. So if you're adjusting $100,000 and $150,000, then 50% of the difference between the $150,000 and your adjusted gross income is deductible. So your adjusted gross income is $125,000. Then you would take $150,000 minus $125,000, so you have $25,000. You can deduct 50% of that. So you would be allowed a $12,500 deduction limitation. If your adjusted gross income exceeds $150,000, then you are allowed no rental loss deduction on your tax return. So basically, if you're a high income earner, rental losses are not in your favor since you're usually phased out of them. But again, the losses do carry forward from year to year. So if you have losses, they carry forward, and maybe there's a year where you make less than $100,000, then you are able to take losses up to $25,000. Or when you sell the property, you're able to take the entire loss carryover in the year that it was sold. So you do get the benefit of that loss at some point in the future, just not in the year that your income exceeds $150,000. So the next thing I want to talk about is who qualifies as a real estate professional. So if you qualify as a real estate professional, then there are no loss limits for your rental properties. You can take losses in excess of that $25,000. In order to qualify as a real estate professional, then more than half of your personal services in the year needed to have been in real estate, and more than 750 hours during the year need to be in real estate. So if you are a realtor full-time and you own some rental properties, then you would qualify under this because you would be dealing in real estate. Or if all you do is own rental properties and maintain them, and your participation in those rental activities exceeds 750 hours for the year, then you are able to qualify as a real estate professional. So when you qualify as a real estate professional, you have the option of choosing to treat all of your rental interests as one activity. This election is binding for the tax year you make it and for any later years that you qualify as a real estate professional. You can add your participation hours together for all your rentals to meet the 750 hours of service. And you need to note that this election can have a negative impact when you have other passive income that you want to offset with your rental losses. Basically, you need to make sure that you really want to make this selection before you make it, since it is binding. Before making the real estate professional election, it's a really good idea to talk to a tax professional to make sure that it's in your best interest. So I just wanted to touch on that really quick. The last thing I want to talk about is flipping houses. So flipping houses is not as popular as it was a few years back before the market went down, but some people are still doing it and still doing it successfully. So when it comes to flipping houses, depending on how you're doing it, they can be taxed. The gain on them, on the sales, can be taxed either as ordinary income or as capital gain income. So ordinary income treatment is ideal when you have losses because you're able to take full loss. However, capital gain treatment is ideal when you have gains because it's at a lower tax rate. So if you are treated with ordinary income, it's like you are doing it as a business and the income is subject to self-employment tax. However, if you are treated with capital gains and you have a loss, you are limited to a $3,000 a year capital gain loss. So maybe you lose $50,000 on the project, you're only able to deduct $3,000 a year until you use up that loss. So when you have ordinary income, it's reported on the Schedule C and taxed at your regular tax rate. And like I was saying, you will owe self-employment tax on any income that's generated, although you can avoid some of the self-employment tax by creating an S corporation. So if you are buying and fixing up and selling houses for your job, it's a good idea, CPA, to see if creating an S corporation is right for you. If that does, if your situation is one where you think that might be likely, then I would definitely suggest checking out John Huddleston's webcast on S Corps to get some more information on that. If you qualify for capital gain treatment, then the gain or loss is reported on Schedule D, and the gain is taxed at your capital gains rate. So the rate is potentially lower than your regular tax rate, and there's no self-employment tax on the gain. But like I was talking about before, losses are limited to $3,000 a year. So you can't just choose whether or not you want ordinary income treatment or capital gain treatment. But there is a fine line between which one you qualify for. So the IRS is likely to consider it ordinary income if real estate investing is your main source of income. So if all you do is buy, fix up, and sell houses, the IRS is going to say you're in the business of house flipping and you need to report it on the Schedule C. Also, if you own and or sell multiple properties, so if you're doing this multiple times a year, even if you have another job, they're probably going to say it's ordinary income. Also, if you have significant sweat equity into the properties, so if you're buying one, going in, fixing it up all up yourself and turning it around and selling it within a month or two, then it's going to be considered ordinary income. And one last thing is if you own the properties for a short period of time. So like I was talking about before, if you're buying it and turning it around and selling it within a month or 2 or 3, they're probably going to say you're in it, in the business of doing it, and therefore it's ordinary income. So the IRS may consider it capital gain income if you own and or sell only properties, if you hold the properties for long periods of time to let them appreciate, and no significant improvements are made through sweat equity. So maybe you're looking around right now, seeing a lot of good deals on properties since the market's low. You want to buy 1 or 2 properties and intend to hold on to them until the market turns around, at which time you plan to put them up for sale and hopefully turn a profit. And you did not go in and significantly remodel the house, then that's going to be considered an investment property and have capital and gain income treatment. So again, since it's a pretty fine line, really, about whether or not it's ordinary or capital gain income, it's a good idea to consult a tax professional. Okay, we went over personal home ownership and how it can reduce your taxes by allowing you to itemize your deductions on Schedule A, deduct your mortgage interest, real estate taxes, and a couple other things. We went over real estate ownership and how it's not quite cut or dry. There's loss limitations, there's repairs versus improvements, and loss limitations. And then we talked about how there's also advantages to owning rental real estate. You're able to offset the passive income, able to take the real estate professional election, and then the difference between flipping houses and investment properties. So that's everything I want to go over today. So I'm going to unmute everybody, and if anybody has any questions, you can feel free to either ask them in the chat or ask them out loud. Let me unmute everybody here. So did anybody have any questions? Okay, again, in case anybody came in late, I'm going to make sure you register at smallbusinesswebcast.com so you can be made aware of future webcasts. And again, our website, Huddleston Tax CPAs, if you want to check out what we have to offer or if you need any help with accounting. And also, I want to let you know that we're going to be sending you a free tax review coupon in the next day or two. What we do is we offer a service where we will review your previous tax returns, 2008, 2009, 2010, to see if any deductions were missed. Our firm's record for finding money for clients by reviewing previous returns is $44,000. So we would love to beat that if possible. So feel free to make use of that coupon when we send it to you. So were there any questions?
Yes, I have a question. Can you hear me?
Yes.
Hi. I just wanted to know, what if you do like kind of exchange, if you buy a property and you sell a property?
Well, I mean, if you own a rental property and rather than just selling that, you'd like to do a like-kind exchange for another rental property, then the benefit of that is that you can defer gain until the sale of the new property. You would basically use a service that specializes in doing like-kind exchanges, and your basis in your original property carries over to your new property, and you're able to wait to recognize any gain or loss on that until the sale of that new property.
Do you attach a statement, or is there a form that I should fill out?
Well, have you done one, or are you thinking of doing one?
Yeah, I have a rental property in New Jersey that I might, might sell.
Right.
All things depending, of course.
Well, you would need to use a service that will do the like-kind exchange for you, and then once you do it, there's a form on the tax return that you would need to fill out to show that you did a like-kind exchange.
Oh, okay, that's good. And can you just clarify, what did you mean by sweet equity?
I'm sorry, I didn't get that last part. What did I mean by
sweet or sweat equity?
Sweat equity?
Yes.
It's when you go in and do yourself do repairs or improvements on a property. It's considered sweat equity. Like you're going in and doing the work yourself.
Okay, I understand.
Yeah.
Awesome. Thank you so much.
Are there any other questions?
Take care.
Okay, so if nobody else has any questions, then, or if you think of one later, feel free to email me or give me a call. But if nobody else has any questions, then that's all for today, and have a great rest of your day.
Bye-bye.